Interest rates seem to be higher for longer, and global venture capital investments have fallen to a 5-year low in the first 3 months of this year. Now, this is according to the latest data that we're getting out from PitchBook. Well, our next guest warns that higher rates are stifling tech innovation. Joining us now is Maëlle Gavet, CEO of Techstars. It's a pre-seed investor company here with a direct line of insight into seeing how early stage tech companies are raising cash. Maëlle, it's great to chat with you here. So talk to me just about what you are seeing, the interest that you are seeing from some of these smaller tech names, and exactly the challenge that higher rates pose here at this point in the economic cycle.
Absolutely. Happy Monday. Thanks for having me. So when we think about the high interest rate, I think the first direct impact it has on tech innovation is that it limits the ability for venture capital firms to raise funds and then invest those funds into innovative startups. And that in turn reduces the availability of capital startups have to build and grow their businesses. And so that becomes a lot harder in general for tech innovation to appear. That would be the prime driver.
So where are we at in this cycle, Mel? I'm curious, obviously, when we're in a zero interest rate environment, that is amazing because we got a bunch of cash sloshing around. Then that went, and we saw a big slowdown, and we're making our way out of that. Is the slowdown totally in the rear view from your point of view?
So if you're asking me my forecast for the interest rates, my crystal ball doesn't always work perfectly. I would say, look, the Fed is likely going to try to cut the interest rate because of the election pressure. It happens every time. But because the inflation numbers are so high, 3.5% last month and going up from the months before, it is too early for them to do so. And when we having conversation with LPs, we keep hearing that, which is interest rates are high. For the LPs who have multi-asset class strategy, they compare the VC asset class with others, and then they start saying that, you know, they may find fixed income or other asset class more attractive in this high interest rate environment. And so as of today, I am not seeing a fundamental change, even though everybody is hoping that there is going to be an interest rate cut with the election coming.
Maëlle, you put in your notes here that 2024 is going to be the year here of the great venture reset. So talk to me just about that. And then when you talk about the fact that we have this higher for longer rate environment right now, what is that going to do just in terms of competition within the VC space? And ultimately, you would think increased consolidation potentially at one point.
So I think when it comes to the VC environment, we're already seeing, mostly in the back rooms, but very much there, the consolidation at play. You see more and more VCs having a really hard time to raise and moving into what we call the zombie mode, which is when a VC is still active because they're still managing their previous funds, but they can't raise a new fund. And so they're basically step by step closing shop, but they don't have to say so publicly. Again, the fundraising has been pretty difficult. In 2023, the US venture capital firms raised about $67 billion. That was the lowest annual total since 2017. And that was a 60% drop versus 2022. So it's a pretty substantial changes, and I do expect some further consolidation there.